Hi everyone, this is Shang from Save My Sense. I'm a personal finance educator who became early retired in her 30s. One of the biggest courses that I teach is called the Save My Retirement Masterclass. It's a video and Zoom combination course that gives you a crash course in learning how to save in retirement in the United States, and it lasts about 2 to 3 hours total in video time, although I spread it out typically over about 8 weeks of guided courses with the students who take my course. Now, one of the biggest perks of this course is actually the ability for the people who take this course to send me emails on any topic involving retirement and investing during the time that they're taking the course actively. And one of my favorite things to do, something that not a lot of people take advantage of actually, is send me screenshots of the investment options that they have inside their employer sponsored retirement accounts. What do I mean by employer sponsored retirement accounts? This is typically known as the 401k, sometimes also called the 403b, 457b if you work for nonprofits or local government, and the TSP if you work for the federal government. And a lot of times when people first open up these accounts and they see their investment choices, it feels like you're reading a foreign language. It really does. But I want to assure you that actually it's pretty easy to decipher what investment choices you have once you know exactly what to look for. And today I'm going to show you a real life example with real screenshots from somebody's 401k to totally break this down for you and make it as simple as plain English. I'm going to quickly go through the screenshots with you just so you know what a typical list of investments look like. So this person sent me 5 screenshots. And on each page, you'll see down the left-hand side the name of the fund, the asset class, and then a bunch of numbers that show how the fund has performed over time, a net expense ratio, a Morningstar rating, and so on and so forth. First off, fund names. I can totally understand that people get really confused here because it's a lot of jargon. But basically, most funds, which you see here, are mutual funds, and they really only have 3 parts to the name. The first part is the company that created the fund. The second part is what the fund invests in. And the third part is the fund class and the ticker, which is really not all that important. So let's just take, for example, on this page, Goldman Sachs Small Cap Value Insights Institutional Class. The fund was created by a company called Goldman Sachs. What it invests in is small cap. Then the words after that, Value Insights Institutional Class, don't worry about it too much. It's just designating the type of shares that's being sold to the institution that's holding this person's 401k, but you really don't have to worry about it. What I pay attention to actually is the asset class. The asset class in this set of examples come in about 4 types. There is equities, multi-asset, fixed income, and guaranteed. Equities means stocks. Fixed income means bonds. Multi-asset means a combination of stocks and bonds. And guaranteed, this is not something that you're necessarily going to see in most 401ks, but in this person's example, guaranteed is referring specifically to a fixed annuity, which I'll probably explain separately in a call to the people who are taking masterclass. Okay, let's now talk about the equity funds, and that includes all the ones starting from this one named Goldman Sachs all the way down to the State Street Global. Now, when it comes to stock funds, typically you're going to see stock funds divided into small cap, mid cap, and we see a couple of that here. We see a Vanguard mid cap. We also see the Goldman Sachs small cap, like I highlighted, an American Century small cap, an AB large cap. What does it mean? It's talking about the size of the companies that sit in this fund. A small cap is typically a company with market capitalization, meaning if you take all the outstanding stocks, the number of stocks they have, multiplied by share price, you get the market cap. So the size of the company. The size of the company is typically less than $2 billion. Mid cap are companies ranging from 2 to 10 billion, and then large cap are companies ranging larger than $10 billion. So a small cap fund is a mutual fund that invests in a bunch of small companies sizes smaller than 2 billion. A mid-cap fund would invest in companies sizes 2 to 10 billion, and a large cap fund invests in companies with greater than $10 billion in market valuation. Very simple, right? The next one that's also very, very easy to identify in here is the index fund. We see an index fund right here, the Vanguard 500 index fund. You know that this is an index fund that invests pretty much in following the S&P 500. And the key word to look out for here is the words 500 index fund. You'll see some other ones like this State Street Global All Cap Equity XUS. If you break it down, and also if you look on the right-hand side under the Morningstar rating, it actually says foreign large brand. Basically, this is a mutual fund that invests in large companies, so companies larger than $10 billion, located outside the United States. If you move up a couple of rows to the T. Rowe Price Overseas Stock Fund Class I, same thing. It seems to be investing in stocks that are in companies overseas. Let's now look on the page of these multi-asset funds. This is actually a page of target date funds. How do you know it's a target date fund? It's very easy to identify target date funds. They usually have a year in the fund name. Now, TIAA CREF, that's just the name of a company. Again, it's jargon. Don't worry too much about it. What we're looking for, the keywords here, is the life cycle index year fund. That's basically a very big clue in telling you that this is a target date fund. It blends towards less and less risk as you reach the year of retirement, target year. So a 2045 fund is when you plan to retire in the year 2045. And these funds are called multi-asset because they have stocks and bonds. All they do is the closer you get to your retirement year, the more and more the fund moves towards a blend of more bonds. That's it. This person does have a couple of bond funds available to them. They're called fixed income. The reason why bond funds are called income funds is because bonds pay out a coupon rate each year, and that's always been considered income by investors. So that's just a key word. Whenever you see the word income, it means bonds. And so you can see there's one called the BlackRock Inflation Protected Bond Portfolio. That's, again, it's just a bond fund created by the company BlackRock, and the goal of this fund is to protect your investment against inflation. So it typically should move in the same direction as inflation. There are other kinds of bond funds, and again, under this Morningstar column, it'll say what kind of bonds there are. Short-term bonds, intermediate bonds, they're all talking about how long the bonds are for. Bonds are debts. Debts are taken out typically by companies, municipalities, governments, etc. Think about you taking out a mortgage on a house. You could do a 15-year mortgage. You could do a 30-year mortgage. Bonds are just types of debt, and some companies do 1-year debts. Some companies do 5-year debts. Some companies do 10-year debts. And the strategy you want to have when it comes to bonds also aligns with how well you think you're going to get that bond paid back to you over time and the interest rates on top. Now, what is something that I don't look at all that much? The growth rates, the return rates. Why? Because all else equal, if you take two funds that invest in practically the same thing, and I'm going to show you two funds that basically do the same thing here, the Goldman Sachs Small Cap Fund and the American Century Small Cap Fund, they both invest in small cap companies, small cap stocks, then what truly differentiates them most of the time is actually their net expense ratio, the cost of you making this investment. This is what actually really is important to me. You want this net expense ratio when comparing two funds that are similar to each other, that invest in similar things, to be as low as possible. Good thing for this person, when I look across the portfolio and I'm looking at the different net expense ratios, they're all under 1%, and ideally you want your net expense ratio to be under 0.5%. We do see some expensive ones here, like the BlackRock one is 0.51, so that's a little bit above 0.5%, but the target date funds are really great low rates, 0.1%, and the all-around favorite, the Vanguard 500 index fund, super low net expense ratio of 0.04%. If you are a follower of Jack Bogle, the founder of Vanguard, he's always going to say you want to, all else equal, buy the fund that has the lowest cost. And thanks to Jack Bogle, we have Vanguard, the company that he founded, and we have a Vanguard 500 index fund here, and that's the lowest cost fund in all of this person's options. So again, don't look at the returns because the returns are somewhat arbitrary. The true way to measure the success of a fund is all in the net expense. So let's recap everything that I just talked about in this video because I went through it really quickly. Number one, don't get stuck on the fund names. Just remember the first part of the name is the company that issued the fund. The second part is what it invests in. The rest is gibberish. Ignore it. Number two, do understand the difference between equities, income, and multi-asset because those are typically the different ways that people invest and they will have to match their risk tolerance and when you need the money to the type of asset that you're investing in at the time. And then finally, ignore most of the columns when it comes to the investment returns. Really the main thing that you want to be focusing on is that net expense ratio. That's the cost of you investing in the fund, all else equal when comparing two funds that are very similar to each other. You want to pick the one that has the lowest net expense ratio, all is equal. Again, this is Shang from Save My Cents. Hopefully this has been educational. This is not investing advice. You're still investing at your own risk. However, I do want you to go forth and believe that it's not rocket science and that most people can absolutely invest and be very successful at it.